Pinterest is down a lot in the last year, which is expected for these high-flying companies that weren't making a lot of money. Elliott Management just made a big investment in Pinterest and it's garnered a lot of attention. That is one of the questions I want you to ask yourself when you're doing this investment or looking at this investment. Why did Elliott Management go in there and make an investment there? The company is barely making money right now. It hasn't made money in the last 5 years overall. So there are questions to ask about what are they doing. Another question to ask, how are they going to grow their revenue per user? That's a very common question in companies that have to do with internet, social media. How do you drive revenue for... Now the great news is I'm quite sure the average Pinterest user is a female that likes to spend money. So that's great. That's a good way to get some money. I've been on Pinterest. You can see a picture, love it, and look at the couch in there and say, click here to buy. That's a wonderful aspect of Pinterest, right? So this is part of the question you have to ask. One more question to ask. Since this company is not making money right now, what is a reasonable multiple to pay for the company going forward? That's a huge factor when companies are not generating lots of cash. And I understand why they're not doing it. They're investing back in themselves. They're trying to grow and grow and grow and grow. Why show profit when you can use that money to go grow it? I do it upstairs at our 8-9 businesses. I completely put all the money back into the business to grow it even more. As long as I cover my salary of what I want to do to live, every other dollar goes right back into the business. And I love that. That's a good way to grow a company. So let's use our software to go through Pinterest. If you belong to our software, follow along. If you don't belong to our software, I think you're going to love it. And if you're new to this channel, I'm Paul. I'm a value investor. My goal is to look at companies as a present value of all future cash flow. All investments are such. Your goal is to make assessments on that and not overpay for that growth and free cash flow. That is the goal here. So let's take a look at Pinterest. Let's go to stock search, type in Pinterest. Right there. The stock's currently at $22. 52-week high was $65. Overall high was $89 back in February of 2021. That was the famed time when everybody thought that my good friend Kathy Wood was a genius and she was the most brilliant investor of all time. And that was when her company ARK Investment, ARKK ETF, was selling for close to $160 per share. It's now at $40-some a share. So let's go take a look at this company. Let's go through our 8-pillar process. Pillar number 1. We want the 5-year PE ratio under 22.5. Right here on the main page. NA. That means they have not made money in the last 5 years when you add up all the last 5 years. Pillar number 2. We want the 5-year return on invested capital being greater than 9%. So again, we're on the main page. We go right here. 3.3%. Another X. So we're 0 for 2 so far. Now, guys, I'm going to go through these 8 pillars. There is an 8 pillars tab that'll show you all these checks and X's, but I want to teach you this process because I'm here to teach you how to fish. Pillar number 3, we want revenue growth of the last 5 years. So I go to the income statement. 5 years ago, 131 million. Last year, $2.6 billion. That is 20X right there. That is a massive check mark. 20 times revenue. Pillar number 4, we want net income growth. So we scroll down to the bottom, net income. They lost $52 million 5 years ago, and last year they made $332 million. Check mark there. But here's the big loss. I was like, they're going like, wait, how did they lose money? $1.46 billion loss in 2020. Oh boy, at the end of March 2020. So it was barely COVID started, but they must have written something down or something. I have no idea. Let's see if there's something above. Yeah, I don't see it. All right, pillar number 5. Now guys, this is the secret killer investment. If you're new to this channel, I talk about this a lot because everybody ignores this. We want to look at the shares outstanding. Are they decreasing the shares and making you a bigger owner of the company? Or are they increasing the shares and diluting you as an owner and giving you less and less of the company by you just sitting there? So we go to the bottom, 448 million shares outstanding, 656 million. They are diluting everybody. So even if you own back here, you own less of the business today because these aren't stock splits. This is literally the company issuing more and more shares and diluting you as an owner. You own less and less of the business as they do this. Now, pillar number 6 has to do with long-term liabilities and debt. Debt works for a company the same way it works for you and individuals. The more debt they have, the more likely they'll have economic problems if things start to slow down and things don't go their way. So our goal is to find companies that can manage that. So what multiple do we pay? What I just had to do is I go back to the 5-year average free cash flow, 99 million, multiply it by 5. So call it $500 million. Now guys, for growing companies, look at this 5-year average free cash flow and look at last year's free cash flow. Last year, they did $680 million in free cash flow, a lot bigger than the 5-year average. In fact, before last year, they had a negative free cash flow overall. So we want their long-term liabilities under $500 million. So we go to the balance sheet. We scroll all the way to the bottom. Wow, look at this. Total long-term liabilities, $233 million. That's excellent. Very good. Last year, they generated enough free cash flow to pay off their long-term liabilities by 3x. That is awesome. In fact, look at their total liabilities. Their total liabilities are around $458 million. What's their cash on hand? $3.2 billion. Holy cow. They can write a check and get rid of all their liabilities tomorrow and still have $2.8 billion left over. That's a huge factor. So instead of paying $14.6 billion, you're now essentially paying $12 billion to the company because you can take all their cash, pay off all their debts, and still have that cash left over. That's awesome. Pillars 7 and 8 have to do with free cash flow. Remember, free cash flow is cash from operations less your capital expenditures. You can do one of 5 things with free cash flow. You can buy back shares, pay dividends, pay down debt, invest back in yourself, and make acquisitions. I've done this so many times that sometimes I forget these things. You can do any one of those things. So we go to the cash flow statement, cash from operations less your capital expenditures. Now, I put this in here for you. So we go right here. We had 5.3 million to 681 million. So this is our 8 pillars page now. I just went to the tab right here for 8 pillars. Guys, a lot of X's here. No PE because they lost money in the last 5 years overall. Very, very high price of free cash flow. But again, guys, if the company's growing fast, that is not as big an issue. So we're gonna use a stock analyzer tool next. This is the most popular part of our site. It allows everybody to put their assumptions in for the future because we don't know the future. It allows them to make assumptions and tell them based on those assumptions what to pay for the company. So let's go to it right now. Stock analyzer tool. First thing is revenue growth. I'm going to do 10%. I'm going to do 15%. I'm going to do 20%. Now remember, at 20% revenue growth for the next 10 years, that takes their $2.6 billion and makes it $16 billion in revenue. Still very ample. Okay, profit margin. I'm gonna go with 10, 15, and 20%. So again, I'm putting a higher profit margin in than what's reported because as they drive that profit down with such a high margin, that's gonna really drive the profit there. Free cash flow margin. I'm gonna do 20, 25, and 30. PE, 14, 16, 18, 14, 16, 18, because I think they're an acquisition option. And finally, for desired annual return, I'm gonna do 15%. Why? Because it's risky. There's a lot of things that have to prove out. We don't know a lot of these numbers to be true. We're really taking a lot of risk in it. So I want a bigger piece for this. I can get 9 or 10% from investing in ETF. So why not get myself a much bigger margin of safety? So I've hit the analyze button. Now guys, down below here are 6 numbers three based on earnings, 3 based on cash flow. If you like this whole video, but it's a little confusing on it, rewind and watch the stock analyzer tool over and over again. The more you understand that, the better you'll be about evaluating stocks with our tools. I use this thing every single day to look at all these companies. Our users in the community, thousands of people active every single day, use this, and it's a very important part. It's the most common thing we discuss. I see screenshots in here of people saying, hey, here's my analysis for X company. It's very, very useful. It's not the end of your analysis. It's the start and middle of it and the confirmation of it. You use it all along the way. If it's all green, it doesn't mean you go out and buy the company. It means go make sure these numbers are accurate. If it's all red, but it's pretty close, again, go make sure these are accurate. Set a watch list. Set it to your watch list with the plus mark. That way, when it does hit your desired price, you go jump on it. And if it's way far off, let's say right now the stock's at 22 bucks. Let's say the stock says $100. It needs to be, the stock needs to be at $5 for you to buy it. Just ignore it. Why waste your time doing research when the stock needs to fall 80%? Go find another stock. So we hit the analyze button, or scroll on the bottom. All right, guys, we're in the middle here. A low of 7 to 14, a high of 32 to 49, and somewhere in the middle here is where we're at right now. So what I would do is I would go do more research. Guys, thanks very much for your watching. If you like this video, subscribe to our channel, and please watch the next video, which is the 8 steps to understanding a stock and evaluating a stock. Thank you very much, guys.